Morning and welcome to another episode of Money Matters, only here on onedealaway.com. And yesterday we ended that we're going to talk about how sort of banking is going to change over the upcoming years and potentially decades, and how what we think about banks may not necessarily be what we end up experiencing in the future. So the banking as we know it is going to shift, and that is something that we're going to discuss today. We're also going to take some reports from the IMF and as well as from the World Bank, just so that we have a bit of an understanding of what's going on. And that's going to wrap up today's show. So we have a lot of really cool and important things. We're also going to geek out on some of the charts and graphs where you can go and discover for yourself and also be able to monitor things on your own and what's going on in the economy. So we're going to cover quite a bit of things, and I'm really excited for this. So let's do this. All right, and good morning to another episode of Money Matters. So let's get started with the first news article, so to speak, from Bloomberg. And, it's interesting. They're just sort of a recapping of what has transpired and how the virus has changed our behavior. And they're saying, 20 graphics, but when I pulled it out, I only have a couple of graphics. So for some reason, I'm not getting all 20. And maybe I've been a very bad boy, so to speak. And I can't see it. So maybe when you pull it up, you'll be able to see it a bit better than I can. But, here we go. Let's just kind of take a look at sort of what's going on. And they're basically saying, like early virus kind of came in. It destroyed basically the economic that we haven't seen since the Great Depression. And, the effects on basic metrics such as gross domestic product, unemployment, collapse in demand for fuel, rapid adoption of telehealth, and surge of liquor purchases. And that all makes sense, right? That makes sense. So let's take a bit of a look briefly, and then we're going to switch to some stuff. But I think it's important to kind of recap of what has transpired. We've all been stuck in our homes for so long that sometimes you forget that there's a bigger world out there. Bloomberg Economics has revised its estimate for global contraction in 2020 to negative 4% from earlier forecast of negative 0.2% in March and growth of 3.3 at the start of the year. We're seeing this all over the place where people are saying, yeah, we're definitely contracting as a world. And I'm thinking to myself, like, duh, we all knew that. Businesses are reducing costs through temporary and permanent job cuts. And of course, we've seen that, and we've seen some of the changes around that stuff where, we've been cutting. Now, as the economy is reopening, some of the jobs are starting to come back. We'll see what the momentum actually ends up putting through. And so we'll see kind of what's going on. The IMF forecasts a surge in annual unemployment rates of developed economies, including the U.S. And so this is kind of what they were doing for the 2020. As you can see, Italy is going to be rather painful. France, not as painful as Italy, but right there. Germany and Japan seem to be doing kind of okay-ish. Canada, UK on the right. And then US, it's very interesting. They're saying like, we don't know. 3.75, 10.2, we don't really know. So they're given a very, very wide range. And it's very interesting when you take a look at this stuff, because I think all of us feel that way. We don't know exactly how this is going to play out. We have no clue how, what's going on with the markets. We were looking at stuff, and I've been saying like, this is unsustainable. This doesn't make sense. But the markets keep going up. And so, it's one of those things of, don't fight the trend. Don't fight the trend. The UN projects a widespread decline in hours worked. And so this is sort of the estimate change in working hours. So the little white guy that you see over here, that's the fourth quarter of 2019 to first quarter of 2020. And then this green guy is the fourth quarter of 2019 to second quarter of 2020. And they're basically saying that people might go back to work, but the hours worked is going to be severely impacted. And you can see that, it goes to like negative 10% to like negative 12% and a little bit over 12% in the Americas. Now, Europe furloughs huge swaths of its workers. Millions have been temporarily laid off in Western Europe. So what has happened in U.S., a lot of people got laid off, and as well as furloughed, and both categories count by the way that we count things. Both categories count in the unemployment numbers. In Europe, it sounds like it's a bit different. And again, if you're from Europe and you know this, because I'm not there, please do correct me in the chat as well as in the in the comment section as well. So please do let me know of what's going on. And so wanted to also talk about how you have millions of workers that are being furloughed, and as you can see, one dot is a million, and green one is the people that are furloughed. And you can see that UK is 19%, Germany 23%, Italy almost 30%, and France well over 40. Well, 41. I don't know that that's well over 40, but definitely over 40. They're also arguing that women will suffer more from dividing labor, and so they'll actually lose more. And they're saying that they hold a disproportionately large share of jobs in the fields most at risk of being affected by the pandemic. And so they're saying 53% of women in the informal economy are in the sectors deemed to be at the risk of high to medium impact from the pandemic, compared to 44 for men. Then they kind of have these different things, and I think they were supposed to have all of the graphs and stuff, but as you can see, they're not showing up on my end. Some businesses will automate operation, leaving workers in alert. So they're saying robots could actually come in and take charge of some of the stuff. And I think robots are coming. When a pandemic happened, didn't happen. That was coming our way anyways. I think we just might speed things up a little bit. Energy, of course, demand for fuel has gone down. Price war between Saudi Arabia flooded the market, leading to the futures for oil to turn negative. And there we go. Consumption, transform how we spend money. We're going basically mostly online. The buying climate fell with the personal finances. Distancing kept consumers at home. Obviously, all of the malls, stores, everything else was closed and shut down. Online shopping has been plagued by shortages since everybody's ordering stuff. And again, it depended on what you were ordering. Adoption of virtual healthcare, right? Telemedicine has been really huge. But one of the interesting things that sales at UK of alcohol stores jumped more than 30% in March, which again makes sense because in panic, and interesting pieces, those stores are one of the very few that were open. So you were like, I'm going to go for a walk. Oh, might as well get a bottle of wine. So anyways, let's change over to the World Bank and the global economy, heightened action, subdued growth. So they just released a report that was really interesting. And they're saying that the economy has slowed down to its slowest pace in 3 years. International trade and investment have been weaker than expected, which I think we all expected. I mean, when you shut everybody down, everybody's at home, things end up stopping. So that makes perfect sense to me. Growth in the emerging and developing world is expected to pick up next year as turbulence and uncertainty that afflicted a number of countries late last year and this year recedes. So they're basically kind of given a bit of it's interesting. So there's a video that kind of explains it, so you can kind of take a look at it. We can take a look at it together. So growth forecast, they're basically saying we're changing it. Advanced economy, original pieces, they're changing it as well. So emerging markets, developing economies, they were expecting 4%, but again, it might be a little bit lower. So it's definitely an interesting piece. Very, very short, not a whole lot of information, but I think it's important graphic when we're talking about trying to understand what's happening in the world around us, right? Let's see. A further escalation of trade disputes between the world's largest economies, renewed financial turmoil in emerging developing economies, or a more abrupt acceleration of economic growth among major economies than currently envisioned. Those are some of the risks that we potentially could face. And here is the global business confidence. And as you can see, we were pretty low in the 2016. It kind of has climbed up in November of 2017, and we're going back down. But again, they don't show the 2020. They're showing a very historic piece, and it's really weird because this was just released this end of last week, right? So it's very weird that a lot of the data is lagging severely. I mean, we're talking April 2019, so it's like well over a year. But I guess when you're World Bank and you have much of the world or all of the world to take a look at, it takes a while to crunch that information. So stronger economic growth is essential to reducing poverty and improving living standards, which we all agree to that. We all understand that. And because equitable growth is essential to alleviating poverty and increase shared prosperity, emerging markets and developing economies need to reinforce protections they have against sudden economic downfalls. And, that sounds lovely. But again, I think everybody is doing their best, and not everybody's prepared because, us humans, we're a very interesting bunch. We do something, we prepare for inevitable when inevitable happens. We're not so good at preparing at the good times. It brings it back to that story of, the ants and the, oh my gosh, the grasshopper, when the ants are working all summer long, and the grasshopper is like, playing the violin and hanging out, and everything is great. And then winter comes and the ants are like, okay, we're ready. And the grasshopper doesn't, is like starving and saying like, hey guys, can you let me into your house? Because I got nothing. And they were like being really mean, and they were like, you should have thought about that in the summer. Well, I think that talks very deeply about us as humans and our behavior, that when things are great, when we're making good money, when the economy is running well, we tend to get into more debt, spend more money, and like our behavior changes. When we're hit with something like this, where we're shut down, money's not coming in, everything is contracting, people are losing jobs, fear comes in to play, and we start to think of like, oh my gosh, I should have done something a little bit better with my money before, but because I haven't, let me do it right now. And so I think we do that a lot, and we see it now with people of all ages, genders, races, skin colors, and everything else are behaving in a very much the same way of saying like, well, the neighbor lost a job and I could be next, so I better start saving up. We see that now in panic everywhere, but we see it also with the aging populations where, you start up and you get, in your teens, of course, you're not necessarily thinking about it because you're trying to figure out what college to go into and, who is the good person to go date and how do you go party, right? And then you get into your 20s and you're just trying to figure out like, all right, I'm so glad I don't have to study anymore and I have this job. And so we go into this spending frenzy of like enjoying hanging out. And then we get into the 30s, and by that point we might start a family and we might have a spouse, and we look to potentially buy a first home if we can afford it, or rent something a bit bigger than what we had in our 20s when we were bachelors or bachelorettes, where you lived with roommates still. And so you get into that stuff, and then all of your money kind of goes towards that. Then you hit your 40s, and by that point the kiddos are starting to grow up, and you gotta go, man, I gotta educate them, right? So that costs a lot of money, and so you start putting money towards the education stuff. The little starter home that you started with is no longer big enough because there's more of you in the family, so you want to move on up in the world, so you get into a more expensive, bigger potentially house. Then the kids go into the college, by the time you're late 40s or in the 50s, and you spend all of the money. By this point, the kid graduates, you're in mid-50s, and you realized, holy mackerel, I'm about to retire in 10 years or less. I don't have any money saved up. So then we start saving up potentially and trying to figure out like how do we do these things, and that's very typical, right? So that by the time you hit the 60s or 70s, then you can actually retire. And we all know you should start planning for 70s when you're in your 20s, but we don't do it because it's so far away, right? It's like, it will come someday, but it's not happening right now. And perhaps this sort of what's going on right now is something that we could all use to sort of prepare us, not just obviously for what we're living through, because this is going to pass. Things are going to change. We're not going to sit in this and for forever. But I think it's important for us to learn from this to say, I got to get better. I got to save a little bit more. I got to invest a little bit smarter. I got to diversify my funds so that I'm not just in one particular asset class or a market. I got to educate myself on some of the things. And perhaps that is the reason why you're here, so that you can learn how to do these things. And you're thinking of, I need to restructure my debt or eliminate it completely. And so, that's all of the stuff that I think it's really, really valid. So anyways, let's go back to the article. I went off on a tangent. So this is an interesting thing where they're talking about the government debt has climbed since the financial crisis. So I'm gonna go back and let's play and watch together, and you can kind of see how it's starting to shift differently based off of the low merging and advanced economies and how it's sort of moving. But again, it only goes till 2018. It doesn't do anything as far as what happened since 2018. And of course we know that it has imploded. So it's very interesting that they are having this stuff posted, but it's very lagging, very, very lagging. So World Bank analyst finds that low and middle income countries will need in the range of 640 billion to 2.7 trillion in investment a year to meet development goals by 2030. So it's a pretty good article. It's just part of it that I struggle with is that falling behind. I feel like they're falling behind as far as the reporting, because they're only going back to like 2-3 years ago, which doesn't serve us any whatsoever. So that's kind of where I stand with this. I don't know. Let me know what you think and how you feel about the whole thing. So just a brief thing from IMF. I want to talk about economic outlook as of April of 2020, the Great Lockdown. So they do these sporadically through IMF. Again, they have a lot of stuff over there, but I don't feel like they're very good at putting things out there for the public in general. So they were talking about that, the global economy projected to contrast by negative 3% in 2020, which we all know and have been expected. And the global economy is projected to grow by 5.8% in 2021 as economic activity normalizes. So this is it. This is all of the report that I could actually find. I'm sure that you can find a whole lot more. So it wasn't much of a report other than like a paragraph. But the nice part is that we all know that it's going to that things are going to go down very sharply, and it's interesting that they're saying that we're going to jump in growth in about 6 months to 12 months or so. So it's going to be interesting. What that lets me know is that if I was to follow this particular projection, which may or may not be accurate, right? I mean, they're guessing at best. Then I would say, now is the best time to start investing, because, if I can get in at the low, heck, I'm going to go for it. But, we also know that it's not necessarily as low, because things have recovered rather sharply in the stock market area. But again, we'll see. Many people are expecting that it might go further down. So we'll see kind of how it works out as the reports start coming in, and the, when people go in and bet on the markets, and I call it bet because that's really what it is, you're trying to guess as to what is going to happen, right? Nobody knows exactly how things are going to play out. And so when we saw these large jumps in people buying particular stocks, they were betting that the increased potential activity is going to result in increased revenue, in increased return, earnings per share, and that kind of stuff. So they would go in and buy. And then now we're starting to see that the stocks are starting to crash in some of those businesses because the revenue is not there to support it. And I fear that we might see some of that stuff kind of start to happen. Again, I could be wrong, but it will be interesting. The part that was really interesting to watch with the stock markets is Hertz. As you know, they have filed for bankruptcy. Then they used, they laid off a bunch of people. Then they're working through their restructuring. Then they gave bonuses to their executives, and on all of that, their stock jumped, absolutely jumped, because people were jumping in and buying it, hoping that they will get it at the low of the market and that something's going to happen. So that's gambling to me. That's not investing. That's gambling to me. But that's just me. You definitely have a different opinion. So let me know in the chat. Let me know in the comments, depending on where you're watching. And if you're watching this on YouTube, you're missing the show. You missed it already. The show already happened, and you're watching just a replay. But it's one of those things that if you can't watch live, heck, it's the next best thing. All right. So IMF, Global Real House Price Index. So let's take a look. This is an interesting piece that I have found, and it was really cool to kind of take a look at it, to sort of from a global perspective take a look at real estate. Now, real estate is very local. So just because the price may be super high in one city, it doesn't mean that it's super high in another city. And so this is an interesting sort of concept of looking at global house price index, but nonetheless, I thought it was kind of interesting to take a look. So you can see that we've been climbing steadily. We had this big old bump in 2008, then we kind of dropped down, and of course, if you look at Euro in US, it was much further. Then it sort of tapered off, and we've been going back up. So here is the prices over the past year, and what they have here. Let me see if I can zoom in so that you can. That we all can actually see what's going on. Hold on. If you click on it, it actually opens it. So now I have to zoom back out because you can't see the whole thing. Okay. Nope. Still have to zoom out. Come on, man. There we go. There we go. We got it. We got it. So real house price index over the past year in most countries. So you can see that we have places like Ukraine, Serbia, Turkey, Qatar, United Arab Emirates, where the prices actually have been sort of falling down. They're actually the annual percent change has been down. Then we have right here Peru, Romania, that is sort of flat. And then you have the prices as they have been rising. So you can see that Philippines, it just went through the roof. I don't know what's going on in the Philippines. So if you're in Philippines watching this, can you please let me know, because I'm very curious about this whole thing. There we go. So Portugal, Latvia, Hungary, Luxembourg, Greece, Slovak Republic, Croatia, Slovenia. So on the higher end, it looks like it's predominantly Europe, with the exception of Philippines, of course. The United States is sort of here in kind of like a middle-ish, together with Macedonia, Singapore, Israel, France, that kind of places. Then you have Norway, Morocco, Finland, Iceland that are on the low. Like I said, Italy, Romania, Peru, not much has changed. And then, again, if we take a look at here at the countries. So very interesting piece that I think it's kind of interesting to take a look. Let me zoom in so we can continue on with the different charts that they have. Then we have the real credit growth over the past year. And you can see Cyprus. It just dropped. And it's often associated with house price changes. And it was strong in many countries. So you can see Norway, there wasn't much of a change anywhere. But their prices, there hasn't been any change. Now, I'm interested to see where is Philippines. Because you can't, there's this giant, there it is. So we had the giant jump in a price, and it looks like definitely less than 10%, because take a look over here. It was like 20%, maybe higher. I don't know, maybe they ran out of space, but it looks like 20% price increase. But when you look at, where is it now? I just lost it. There we go. Here, it looks like it's maybe, 6-7%? So that's an interesting piece. The other piece is like Cyprus. Cyprus was somewhere around here. Yeah, so Cyprus kind of saw less than, it looks like 2.5% increase. But the decrease was, it looks like 28%. as far as the real credit growth. So it's very interesting that the people are borrowing less, but the prices have gone up. But I've also been in Cyprus a little while ago, and when I did go to see it, I actually was looking at some of the properties because I was considering potentially investing in Cyprus. And part of the challenge for me was what they were looking for the down payment, at least for foreign nationals. I had to put in between 30 and 50% down, and then I could finance the rest of it. And that's just too steep for me. That's too much equity that is sitting in something illiquid that I didn't feel comfortable locking up. So maybe that's what the case is right now. I'm gonna have to take a look at it and check it out for sure. But this is an interesting piece for sure for me to kind of look at how the prices and the credit are not always one for one ratio, right? You would think that as the price goes up that the credit would go, but that's not always the case. And so it's definitely interesting because there are different components that happen as well. It's not always credit. Sometimes it's the down payments that also played a big role with it. So house price to income ratio around the world, this is an interesting one as well to see that Portugal, for example, we already talked about Portugal. It was one of the highest ones, and it makes sense because, if the prices jump but the income doesn't keep up, the house prices are 125% to income. Then we have, Hungary was also on the higher end of things. Let's see where United States is. So U.S. is just, it's right there. So it looks like it's just shy of 110%. So, it's I don't know how I feel about that. It doesn't sound healthy to me. But you can see the vast majority of the world, I mean, basically from Greece all the way over this way is, really high and really unsustainably high. I would say anywhere from the U.S. on. But then you have Italy where, it's at 90%. And of course, there's some countries that are not even being mentioned here. This is just a small portion of the houses. House price to rent ratio. Now, this is exciting because of the investors. So if you're an investor around the world looking for places, where does it make sense to invest to potentially make money through the rents? Here we go. Here's the nice little global snapshot. So house prices have grown faster than rents in over half the countries, which makes sense because people want to own. They don't want to rent. When you have the supply go in for the ownership, demand stays flat or potentially goes down, the prices go through the roof. And everybody believes that real estate can never go down. It's the best place to go and invest. And you know what, real estate can go down, and I do believe that long term it is the best place to invest and put your capital to work. However, I also believe that you got to pay attention to the prices and to the rent to value ratio, so in order to make sense. So you can see that, I would argue that 80%, if this is the world, which is not, but out of the country that are listed globally, 80% of them are unsustainable. Like, look at Latvia, for example. It's, 135% house to rent ratio. That doesn't make sense. Perhaps better places to invest as a long-term investor would be Russia, Estonia, Finland, Italy, Turkey. We have South Africa, Korea, Lithuania is right there, and then from Chile on, it doesn't even make sense to do it. Now, I'm sure that there are pockets where it does make sense, and in that case scenario, go for it. But, if you look at it on this sort of global scale, it doesn't make sense to me. So there you go. This was definitely an interesting piece that I kind of geeked out, and hopefully you have enjoyed it as well, especially if you're a real estate investor looking to potentially invest globally. You might be very curious about it. Now, one of the things that I have mentioned that I was going to show you is the what we were able to find with the charts and stuff. And this is the dynamic yield curve. And many people watch the dynamic yield curve. So you can see it over here of what's going on with the curve. And then you can see what's going on with the stock market. And, you can kind of see what happened. And you can really play around with it. So you have, they call this flat, which I understand inverted, right? Inverted curve basically means that the short term is higher than the long term, and it's a pretty good indicator of the economic changes and crashes. And you can see it's been super healthy, super healthy. We are starting to get into some interesting territory that personally makes me very uncomfortable. I would call this flattish, but they didn't, and this was in August, and you kind of see it, and now we've sort of returned to a very healthy, dynamic, healthy yield curve, which almost makes me believe of if this was it, perhaps there is no bigger fall down. Perhaps this is it. Perhaps this is as bad as it got, and it's only going to go up from here. So I don't know. I have no clue. Again, it's so weird because when you look at equities, they give you one sort of thought and idea. When you look at bonds, they give you something very different. Then you look at currencies and economic developments, and it just doesn't make sense. And the technicals and fundamentals are not necessarily matching, which makes me not want to participate. So I'm sitting on the sidelines. Not that I'm that big in the equities anyways, but it's definitely something that makes me wonder of what is going to happen. And so definitely something that we're going to be monitoring here one deal away and in Money Matters live. So anyways, this is what we were going to talk about. This is what we were going to talk about. This is where we ended the last episode, and I said the decentralized finance will do to banks what the internet did to newspaper. And this was a really interesting article that I wanted to share with you. And so let me know what you think, and maybe this is an interesting piece for you to look at. But it was a really cool piece to look at, and I truly agree with it, and I believe that this is going to be the case. So the early days of the World Wide Web were heady time for newspapers. Newspapers have been fantastically profitable with monopolistic local markets, vertical integrations, and wide readership. Then the internet hit. Craigslist disrupted the classified model. Ad platforms and search engines started siphoning ad revenue and content later on. Social media accelerated the trend, leading to competition for breaking news, which is really true, because by the time I get, and I still enjoy some of the newspapers when I get them in a physical form, because you get some stuff, but it's really interesting because you can get all of this stuff online. And some of the news has been really interesting because we cover it here on Money Matters because we go so early and we go live. You're able to watch it super, super, super early. And, then we go into you go to look it up in the newspaper, and you were like, I already knew that. That's like, it's old news. It's not even news. It's not information that is useful for me because I've already figured it out. So by the time it was done, 60% of newspaper jobs were gone, and in the process, newsmaking was transformed. So they're basically saying that the 2020 is going to is starting to do the same thing to the banks. And I think it started a little bit before that, but I think we're going to start experiencing more and more, and at faster paces and at faster rates than anything before. So American banks have changed dramatically in the age of the internet. Mobile banking has become the norm. Checks are now scanned instead of physically deposited. The neobanks The neobank is basically, they were explaining it over here. There's a really good Medium article that talks about what neobank is. And a neobank is basically a type of a digital bank that exists without any branches. So it's kind of like an app that facilitates administration of accounts and credits. And that's typically a neobank, and they rely on customers having an account with underlying bank and corresponding bank license, but offer user-friendly interface. So they basically sit on 100% of digital and mobile platform without any physical branches, but the systems are 100% new as well. So that's kind of what neobank is. It's sort of some of the new things that you've seen where there's like an app and it kind of works through different entities to kind of connect your physical bank with you of what you're trying to do. And so it's really interesting to kind of see the development with that. But anyways, the neobanks with a mobile banking focus and continued innovation, paychecks 2 day early, free money exchange, free ATMs, and certain payment networks, bank transfers can happen in real time. And this is an interesting image. Hopefully you can see it. And this was the run on bank in 1931. So this is basically just giant line of people waiting. And it's interesting that they have kind of put this in, because we can probably go in and see run on bank image in Cyprus, right? So Cyprus, not that long ago, was actually experiencing very similar, and I can't find them now, so I don't want to waste time, but had experienced a similar thing. It just people didn't wear, fancy hats. People might have had baseball hats and shorts as opposed to suits and fedoras. So anyways, banking hours are still 9 to 5 on weekdays. That's my biggest issue with the banks. They're open the same time that the rest of us are working. So when you're trying to go to the bank, you can't even do it. And they have incredibly limited hours if they're open on potentially Saturdays, like might be 9 till noon or 9 till 1 or something like that. Physical bank branches, 83,000 plus in the U.S. at last count, are still critical for collecting retail deposits. But I think that is going to shift, because as we're starting to change from physical cash, and many businesses are sort of banning it, and more of us going digital as a whole, there's not going to be a need for a business to actually go to the bank. So some of my businesses are all online, and those that are not online, I prefer to do the banking stuff online with my clients, customers, students, tenants, and so on. And so it's all automatic. It all automatically goes into the account that I don't have to necessarily go into the bank. Every so often, I might have to go in and visit, but that is super, super rare. So, and I think that that's going to happen for the rest of the retailers, and as they sort of start banning cash and start going all digital. Bank transfers still take days, and regulations protect the user funds but also make it difficult for anyone to start a bank. It's a super highly regulated piece, and I mean, if you ever had even read about what it would take for you to start a bank, by I don't know, page 2 of reading, you give up, because it's nearly impossible. Wire transfers still have high fees and cumbersome process to send funds, right? So you got to go the routing, the account, the SWIFT, the receiver name, the address, the bank address, the phone number. The blood type. It's a hot mess. It's a hot mess. And even then, if you mess up, like, it's so nerve-wracking. They were like, if you mess up, the funds are gone, period. We can't recall it. I'm like, oh, okay. So I'm checking the numbers like 17 times. I don't know if you've done that. So even simply opening a bank account takes anywhere from 2 days to 36 days. And yesterday, and let me show you this so you can take a look at this stuff while we're talking. But yesterday we talked about how many businesses are dissatisfied with their banks and are looking to change. Like, what was it? Like 42% of them are saying, like, I think I'm going to change my bank, because it's taking me weeks to get stuff approved or to open a bank account or to do anything. And so you can see right here of how long it takes to open an account. And, it goes anywhere from like 2 days for Barclays, down to like Santander is like 7 days. And then you have Nationwide of 22 days, and HSBC is like 36 days. That's like over a month. And this is working days. Like, it's not just like calendar days, which is different. So I would argue that this is like close to 2 months to get your account open. This is silly. This is silly. And people still opening bank accounts with HSBC. I don't know how. I don't know that I would wait, but you might differ. Now, they're talking about Enter Compound, the anti-bank. Now, Compound only has $117 million in deposits. JP Morgan has 1 trillion plus. So that gives you that it's really, really small, relatively speaking, right? But it seems to be a curious bank challenger. Okay. Now, the protocol lives exclusively in smart contract code on the Ethereum blockchain. And this is another reason, not that I want to switch topics on you, but this is another reason why I'm so bullish on ETH. It's not even funny. because so many things are being built on it, and you need it. If you know anything about Ethereum or blockchain or cryptocurrencies or any of that stuff, you know that you have to have ETH in order to participate in this blockchain to be able to do stuff. And to create smart contracts, which cost gas, which actually in exchange take ETH, you have to have it. So it's a utility token that you absolutely have to have in order to run these things. And so for that reason alone, I believe in ETH so much, that, it just proves it right over here. So anyways, there's a bunch of stuff over here that I'm sure that if you're a programmer and coder, it means something to you. When I look at it over here, I got nothing. I mean, I can see that there's EIP 20 token, and that there is, public constant decimals of 18. So, like, I can understand some stuff. Mostly, I have no clue what this all means. I know that it was programming Solidity, but Ethereum is programming Solidity. So, for now, it sounds like it's going to be shifting to Viper, I want to say. So, anyways, lots of changes, lots of developments. Let us continue. Now, just a few million users in the world have figured out how to access blockchain networks. But Compound augurs a seismic shift for banking. At its core, a bank is a surprisingly simple beast. Savers deposit funds at low rate. Borrowers borrow them at a higher rate. The bank makes money on the spread or net interest margin and ensures the borrowers pay it back. Both the bank and government aid to make sure that the borrowers don't all come calling at once, preventing a liquidity crisis. So that's the simplest way to look at banking. There's additional pieces that the banks end up doing, but at the bottom rate is banks make money when they lend, when they allow you to save. Excuse me. The air went the wrong pipe. I think I'm the only person in the world aside from my late mother who can choke on air. So I think that it's a fine quality that I have acquired from Mom. So thanks, Mom. So it's a basic way of kind of how the banks work, right? And it makes sense for them to lend, which is why so many banks are pushing on the lending piece unless they get petrified and then they don't lend to anybody. But anyways, so by the definition, Compound is the bank, right? The definition of you have savers, you have borrowers, and you make money on the spread. And that's the reason why, because the money's made on the spread. When you borrow, you pay, I don't know, let's say 10% on a good day. And but when you save, you make what? I don't know, 0.1%, if that. I don't even know what the rate is these days, but I know it's super low. Anyways, by that definition, Compound is a bank. Savers deposit crypto assets to earn a yield. Borrowers borrow these tokens, but also offer collateral. Compound makes money off the spread, but Compound has a few superpowers that banks don't. Compound is global, so anyone, anywhere, 24/7, 365 or 66, depending on the year, can access this. Before the Glass-Steagall legislation was repealed in 1999, banks weren't allowed to cross state boundaries. Today, there are few worldwide banks. Smart contracts in the blockchain make worldwide banks not just possible, but trivial, right? So that's the cool piece, because it's global, right? I can be here in United States. You could be somewhere in Kenya. We could be on the same network, and maybe you deposit money as a saver, and I borrow it as a borrower, and you make money, right? And I'm able to do stuff. I get liquidity, then I of course pay it back. So that's kind of an interesting piece for me. Compound is regulated by code, not people. Banks are highly regulated because they control your money and can run away with it or poorly lend it. Now, they limit who can start banks, reducing the competition. Compound enacts its own regulation. Their developers write the protocol and reserve most of the rights for the users or voters. So when you join the network, then you're able to vote of sort of what is this going to do, what's going to happen, what do we approve, don't approve. So it gives potentially a bit more control to the network. And if the network changes how they do stuff, you can change it very easily. You can just withdraw, leave, and that's that. Now, same thing you can do with the bank, but, if the bank shuts down, you can't access any of that money. So there goes that. It doesn't mean that Compound comes without risk. Borrowers can still default and the code can have bugs, but the Compound owners can't run away with the funds. So this is one of those things to pay attention to when it comes to smart contracts and blockchain. And again, it's still very, very new. So it has a lot of potential and possibilities, and we're still going to grow and develop. But pay attention that no matter what, whether you use the regular banks, whether you use crypto and blockchain, whether you are just a private lender, just privately dealing off anything with anybody else, there's always a risk of default, right? That person won't be able to pay back or won't pay at all. So that's one piece to pay attention to, which is where collateral comes into play to secure the loan so that you make sure that you don't just lose your money, that if they don't pay back, at least you get an asset that you can potentially recover all or at least portion of what you have lent. And if you know how to do the whole lending piece, then you understand of what you need to do to protect yourself, because you put way more collateral than what you lend, so that it's really, really painful for them to default, because if they do, you end up potentially making even more money. So something to know and understand. And if you want to learn how to do those things, that's one of the courses that we're going to be offering pretty soon in the Academy. So if you want to check out the Academy with all of the different courses where we talk about crypto and real estate investing and just all kinds of cool things from marketing and business startups and that kind of stuff, we're also going to be talking about the lending and things that you might want to know, that you absolutely must know if you are going to become a lender, if you want to decide that you want to play a banker, so to speak. Code, on the other hand, also has a bit of a challenge and the risk that you want to make sure that it's coded correctly, because last thing you want to do is put stuff in a smart contract, but it's not triggering the way that it's supposed to. Okay, the blockchain, like the internet, is 24/7 and super fast. Compound can take advantage of global transfers that move in a matter of minutes or even seconds, and $1 billion can be sent for only 50 cents. That is crazy, right? You can send, it doesn't matter how much you send, it's super, super small fees. And, if you send $1 and it costs you 50 cents, then it's really expensive. But if you are sending large amounts of funds, then it's super, super cheap. Now, by comparison, I didn't highlight this stuff, but it is interesting for you to understand. By comparison, the U.S. banking system is cobbled together from the 1970s COBOL mainframes stitched together in the aftermath of Glass-Steagall consolidation, which means it takes them forever. It takes days, if not weeks, to transfer money from one place to another. So when you try to transfer money even from your account, like say that you have two bank accounts in United States and you try to send from bank A to bank B, it's your account, everything is the same United States. You might be able to do some of the stuff even online potentially, but it takes, potentially days. Now, Zelly has actually, or Zelle, I don't even know how you say it, so correct me. But, it makes it a little bit faster with the cell phone and stuff. So I think that that's one of the advancements that we're seeing. But traditional banking, it would take me days and it would cost me quite a bit of money. But if I try to send something like, traditional fiat, for example, to my family in Europe, or they try to send it to me, it costs us money, and oftentimes, depending on the bank, both parties have to pay. So I, as the sender, have to pay a fee. They, as the receiver, have to pay a fee. That's double the fee for the same darn thing, and they don't do anything. They don't do anything except enter a few digits and press a send button. Well, COBOL is a little bit more labor intensive, so maybe they do a little bit more than just that. But, not much more than that. And it takes forever, because I can transfer money now, and it will take about a week to 10 days for them to get it. Contrast, if we go with the blockchain and crypto, I can grab my phone, right? And I know their public key, right? I know the address. I can go in, I can, take that thing, click it, and within minutes, I get a text message back saying, got it, right? Like, that's the power of what we're talking about here with the blockchain and the decentralized finance and the fintech as well, right? So it's unbelievable. So the future of financial services. Now, we are simply redefining the banks. We are redefining how we got news in the 21st century. Now, we're redefining how we work and what banks are and how financial services and system works. It took 20 years for the full force of internet to be felt on newspaper. Users will need to be able to access the blockchain. Smart contracts will have to be debated, and risk management will need to become the norm. But the future is already here, and I agree with it. The dislocation won't stop at banks, but hit much of Wall Street. Since the launch of Bitcoin in 2009, cryptocurrency exchanges have proliferated, creating alternative to trading and to the financial system where you can go and trade 24/7, 365, 366 within assets around the world. Smart contract projects like DYDX, which is one of the decentralized exchanges, make shorting trivial and liquid. Exchanges like Uniswap and Kyber allow worldwide trading to any asset at any volume. Though fintech innovation has accelerated in the last decade, real financial disruption is just starting. And I agree. And one piece that I also want to point out that it did take 20 years for the full force of the internet to be felt on the newspaper. However, I expect that it's going to be cut in half. So I think it might be like 10-ish years, maybe even a little bit less, before we see the final pieces of what's happening with fintech and DeFi. So I don't expect that it's going to take 20 years because, we are moving at a much faster pace now than we did before. So anyways, that's kind of where I stand. So here you go. This is basically the news of the day, of what I wanted to share with you. Hopefully you have learned quite a bit and that you're excited. Personally, I'm super excited about what's happening in decentralized finance and the world. And, if you're confused about smart contracts and don't understand some of these things, and you're sort of curious about cryptocurrency, Crypto 101 course is the course that we're actually developing right now. So we've had already 2 live sessions. We're going to have another one where we're going to wrap up some of the things, and it's going to be this really big picture of understanding what blockchain is, what crypto is, how you can participate in it, some basic stuff about evaluation, valuation, analysis, and that kind of stuff. You're not going to learn how to program, but you're going to be able to learn, how to benefit from the stuff and some of the reviews of like, where do you go to find some of the information so that you're not just typing in stuff in Google. Because when you type in stuff in Google, for example, which is what a lot of people use, you get this mainstream media stuff like CNBC and Bloomberg and that kind of stuff. And for some of the things, they are really, really cool. But when it comes to this technology, they're not quite up on it. There's this entire brand new world that exists that, unless you're a programmer, unless you're in that space, you don't even know about. So anyways, I invite you to check out Crypto 101. And if you're looking for additional courses and all of that stuff and you want to save quite a bit, Academy is going to be the place. And at some point in the near future, we're actually going to start discontinuing all of the courses. Well, not necessarily discontinuing. They're going to exist, but, it's going to make much more sense for you to actually join the Academy than anything else. And, the cool piece about Academy, you can cancel anytime. So it's sort of on a month-to-month basis. No long-term contracts, no long-term commitments, and you get to try it for free for a few days. So there you go. That's it. That's all I got for today. Have an amazing Sunday. Be productive. Be proliferating. Oh, I did want to share something with you that we were able to create and do with One Deal Away. And I wanna show it to you. But how do I do this? Hold on. It does something funky. There we go. All right. So let me show you this. So we've done something different. I told you that every day we're going in, we're tweaking the website, we're adding things on it. Not only are we adding the courses and stuff, but we've actually developed the news page. So if you are interested, you can see it right over here, and you can see the news page happening. Hold on. Let me see if we could zoom out some so that you can actually see it. Okay. Because I just want to show you of, I'm not a programmer, I'm not a coder, so for me to be able to do some of these things and work with the group is really exciting. But you get to read some of the top news. So you get Financial Times right now. There's the Business Insider. There's the crypto news that is coming in. We have Market Watch news that are going to be delivering, Yahoo, Wall Street. So we're going to be delivering and expanding this stuff. And of course, up here on top, you get the crypto scroller. And if you ever want to check it out, say that I want to check on CRO, I simply click on this it takes me to CoinGecko, and I'm able to explore of what's going on with this particular currency, and how to be able to benefit from it. So be able to buy it, evaluate the charts, and so on. So, anyways, I'm really, really excited about kind of what we're doing and developing within the website. So make sure you check it out. We'll be adding more stuff, more news. Really want to create this as a one-stop shop where you can get all kinds of cool things and information when it comes to money wealth, how to make it, how to preserve it, right? And to learn how to do a lot of different things. So, anyways, we're done. That's it. I'm going to go and now hang out with the folks over at the chat. But for the folks watching the replay, this is it. This is it. This is it. We'll see you tomorrow at 7 a.m. on onedealaway.com/live. Until next time, stay forever money blessed. And do remember, you are only one deal away.